Hi, Kara Lowrie here, your local mortgage expert here in Louisiana. And have you ever Googled what could I qualify for if I make $60,000 a year? Well, if you have, then it's kind of hard to get answers to those questions because there are a lot of factors, that are involved in that. But what I'm going to do is I'm going to break it down step by step and how we arrive in trying to calculate or trying to figure out what you qualify for. Because before you go out and about and looking, you want to know what your true buying power is. Because the last thing you want to do is to go out, look at houses that are above your price range or above what you want to pay every month. Because let's face it, sometimes you qualify for more than what you have personally budgeted for your family and what you're wanting to spend per month. Because there are a lot of things on the credit report that, of course, that we can see, but there are a lot of things that are not on the credit report that you like to do as a family. Maybe you like to do a lot of traveling. Maybe you have travel ball or dance classes or a lot of extra coaching. So there are just a lot of things, a lot of life expenses that are not just on a credit report. So we always want to know what your budget is and where you're trying to stay around, because ultimately I think that's my job. Educate you, give you information so that you can make those decisions for you and your family, not just me on the outside saying, well, here's how much you need to spend every month. No, it has to be, there has to be a synergy between your loan officer and yourself, because my job is to educate you and give you the information that you need so that you and your family can make educated and informed decisions. And there's a lot of ways to do that, but not just giving you a bunch of information just to say I gave you a bunch, because we all know there's a lot of information on the internet. There's a lot of wrong information on the internet. And then you have agency rules. And then when you have those agency rules, then you have lenders that can then put rules, layering of rules on top of the agency rules. So we can't take any of the agency rules off the table, but we can add to them. And sometimes they do. So kind of back to, what does your true home buying power look like? So we're going to take the confusion out of that and take the guesswork out of that and get you some direct answers. So by the end of this video, you will have a very clear answer, but you'll also know exactly what the factors are that go into trying to determine what affects your buying power and how much you can afford. The first thing to understand is that affordability isn't just about your salary. Like we talked about, there are a lot of extra things that go into that, but there are four main things that go into that. One is your income. The second are your debts. The third is your credit score. And the fourth is your interest rate. So let's go back and start with your salary. So for this example, we're going to use what we talked about earlier, the $60,000 a year. So that equates to about $5,000 a month. And whether that's salary, whether that's average commission, whether you're self-employed, and we've averaged your income over 2 years. So there are a lot of analysis that goes into whatever that calculation of your salary is. But for this example, we're going to use $60,000 a year and $5,000 a month. So let's look at your debts. So I touched on that lightly already. So when we're looking at your debts, we're looking at the things on the credit report. But let's say you have a car note that is about to pay off in a couple of months. Then we may not have to count that against you in the qualification. But let's say that you have alimony, child support, or separate maintenance that doesn't show up on the credit report. Be sure and let us know about that, because eventually it'll show up. Because with all of the tools that we're now required to use, that eventually shows up. It'll probably show up right at the very end when all the excitement is built up. Your family has been picking out bedrooms, and you've bought that new couch. You didn't finance, you paid cash for it, but maybe you've bought that new couch and you're figuring out where everything is going to be placed. So the last thing you want to do is you want to withhold any debts from the very beginning of the loan application, because we'll eventually figure those things out. They'll eventually crop their head up. So the things we're counting, we're looking at car loans, we're looking at student loans. So even if you have a student loan that you're not yet repaying, say it's in deferment, we still have to count that student loan against you, because let's face it, eventually they do come due. It's usually within a year or so, and we want you to be prepared to have enough room within your monthly budget in order to make those payments, because eventually they will start repayment. Because the last thing we want to do is we don't want to set you up for failure. So federal government requires that we do that now, which is a smart thing. So that DTI makes a big difference, or that debt to income ratio. So the third thing is your credit score. Credit scores are basically a snapshot in time of your credit rating. So there are a lot of different types of credit scores. We use the FICO credit score, which is one the federal government requires that we use. Pretty much everything we do is dictated by whatever the federal government requires that we do. Sometimes it's good, sometimes it doesn't make much logical sense, but somebody somewhere decided it was a good idea. Legislators put something into place, and then voila, now we're required to do it that way. So again, back to your credit score. So credit scores are used as a predictability model as to whether you're going to repay the debt. So lower credit scores means a higher risk, which typically means you're going to have a higher interest rate. Now, so that lower credit score affects home loan, is going to affect your homeowner's insurance premiums, sometimes your car insurance premiums. So credit scores, I could talk to you hours and hours about credit scores, but at the end of the day, they're important. Pay attention to what they are. You can also go to places like Credit Karma in order to get an idea as to the trajectory of what your credit scores are doing. Credit Karma actually uses the what's called the advantage scoring model, which is not the same one that they give to us or that they're required that we use. We use the FICO score, like I said earlier. So our scores are always lower than what your Credit Karma score is going to be. So just keep that in mind. Also, Credit Karma is not 100% up to date. Not showing that you're late, but that, for example, the credit card payment may be from 2 months ago, not necessarily this month. So that's another reason why the credit scores are not always exact. They're almost never exact. Our scores will always be lower because they're scored differently. So looking at those credit scores, the FICO score, different things are weighted differently, whether it's a installment like a car loan, or whether it is revolving like a credit card. Try to stay away from the high risk finance companies. I don't want to mention any names, but try to stay away from those because those do hit your credit score a little differently. But you could do a lot of research on credit scores. Like I said, I could talk to you about credit scores for hours and hours. So the higher the credit score, then the better interest rate you're going to be. So of course, that third thing of interest rates, if you have a higher interest rate, it's going to make for a higher payment. Same token, lower interest rates are going to give you, a lower credit score is going to mean that you're going to have a higher interest rate, which means you're going to have a higher payment. So lower interest rates are based on higher credit scores, of course. So that fourth thing, your actual interest rate, that's kind of the wild card. Rates change typically every single day. Sometimes they change many times throughout the day. But we've already talked about the fact, the main thing that go into what your interest rate is going to be, and that's going to be your credit score. It's going to be your sales price and your loan amount, because when we have those last two things of sales price and loan amount, that gives us what's called a loan to value. So loan to value is very important and one of the key components of figuring out what your interest rate is going to be. So here in Louisiana, there are also two additional big factors that can change your affordability based on other states. Now, technically, every zone is a flood zone. Not all flood zones require flood insurance to be purchased. Towards the southern parts of the state, flood zones are different, and flood insurance is dramatically higher in South Louisiana than it is here in North Louisiana. We are quite a bit above sea level. And so if you're in a zone that requires flood insurance, it typically is going to be pretty inexpensive. You may be in the zone, but you may be up high as far as elevation goes. So therefore your flood insurance might be $400, $500, $600 a year. So quadruple or triple that in South Louisiana in a lot of cases. So, but again, insurance can be a pretty big determining factor. Homeowners insurance, we all know that in our state, homeowners insurance premiums have been steadily going up. So as your loan officer, when I'm pre-qualifying you, one of the things that I do is I give a very educated guesstimate on what that homeowners insurance premium is going to be, because just like anything, there are a lot of things that go into that. The age of the home, how, the square footage, bedrooms, bathrooms, fireplace, wood, brick, a lot of different things go into that insurance premium that can make a difference. So again, your loan officer's job is to make sure to give you a pretty good estimate based on their knowledge in the beginning when you're getting pre-qualified, so that you have good information, because that's ultimately what you and your family are basing the decisions on, of what house you want to look at to make sure that it's within your budget. Because if I'm giving you wrong numbers up front when you're trying to decide how much price you want to look, or what sales price of homes you want to look at, if I'm giving you numbers that are really low just to make my numbers look better, I'm doing wrong by you. I should probably lose my license if I am knowingly doing that, because to me, it's unethical. But I won't get on my soapbox about that. Property taxes in Louisiana are fairly low compared to a lot of other states. So that actually is a good thing as compared to the national average. In Louisiana, you also can file homestead exemption up to the first $75,000 of value if it is your primary residence. That's worth anywhere from $700 to $900 a year. So that's a pretty big difference monthly that can make. Now, of course, if it's your second home or if it's investment property, you will not get that homestead exemption. Also, if you were a veteran, we have some very aggressive laws that are put on the books statutorily that give our veterans a lot of benefits in reference to property taxes. So now let's talk about running some numbers. So if we talk about that $60,000 annual salary, which we said $5,000 a month, a safe guideline is that your mortgage payment should be nowhere above, say, 30% of your gross salary. Now, 30% of $5,000 is about $1,500 a month. Now, the confusing part is that when we are qualifying someone, we're actually using two different ratios, or we're using two different calculations. That first calculation only takes into account the monthly taxes and insurance of the new house. The second calculation is going to take the taxes and insurance, the monthly payment, but it's also going to take into account, or into that calculation, what your monthly debts are. And so that's where that one makes a huge difference. So at today's average interest rates, that could translate into roughly a $200,000 to $225,000 home, depending on your credit, down payment, taxes, and insurance. Now, here's the kicker. If your debts are really low, you could stretch higher. If you have a car loan, student loans, or a bunch of other revolving debt, then like we talked about earlier, that is really going to affect the amount that you're going to qualify for. Now, let me give you some pro tips in how to increase your buying power. Pay down your high interest credit cards. Keep in mind, we're going to go off of the monthly payment that you're required to make. So if you have a credit card that on your credit report shows a monthly payment of $0, just because it hasn't kicked in yet, or maybe you're paid ahead, well, if there's no payment listed, then we're going to be required to count 5% of whatever that balance is. So just keep that tucked in your mind. We may want to explore some other programs like FHA or VA, because they do allow us to use a higher percentage of your income in order to qualify you with. Conventional requires that we use a little lower. So if we're looking at FHA, we might be able to go up to 35. If you have debts, we might can go up to 50%. And again, keep in mind, this is of your gross income, not your net income. So bottom line is, if you have a $60,000 salary here in Louisiana and you had no debt, that you could typically qualify for $200,000 to $225,000 house, but your numbers are going to be different based on where you're buying, based on your debts on your credit report, based on your credit rating. So if you're ready to find your personalized number, let's talk. I offer free pre-qualification calls at no cost to you, and I'll walk you through your specific situation. We'll crunch some numbers, and then we'll put a plan into place that is specific to you and your family, because every single person that I talk to, everybody's plan is different because it's based on their circumstances. So click the link in the description, book your free consultation call, and let's get you one step closer to homeownership. I'm Kara Lowrie, your local mortgage expert with Acadiana Mortgage. Thank you for watching.